again. Hello again, everybody. We are continuing Module 3, Financing the Enterprise. Um, this this chapter will be Chapter 16, Financial Management and Securities Markets. In Chapter 16, the following objectives have been outlined. I believe that you will learn as you complete all the activities in this chapter. First, you will describe some of the common methods of managing current assets. You will identify some sources of short-term financing. You will summarize the importance of long-term assets and capital budgeting. Also, you will specify how companies finance their operations, manage their fixed assets with long-term liabilities, and also a brief discussion on bonds. We'll discuss how corporations can use equity financing by issuing stock through their investment banker. And finally, we'll describe the various securities markets in the United States. This particular chapter is not going to give you all of the finite details of financial management, but it will give you some overview of some major areas that I think are important as you begin business your business education. Managing current assets and liabilities. Well, first of all, we want to make sure we can remember what a current asset is. It's going to be an asset that we can convert to cash within a short period of time, very, very quickly, within 30 days. We can also, maybe 60 days is probably the longest, but we're going to be talking about very, very current assets. Things that we can convert to cash. If cash is already cash, and it's already a current asset. And in addition, with liabilities, we're going to be talking about liabilities that are due within 30 days, very, very quickly. And that's going to be accounts payable and other short-term liabilities, but these are going to be due or assets that can be converted to cash within 30 days. So because assets and liabilities short-term flow very, very continually through the business, they're going to be working capital. They are called your working capital. And this is going to be very important because it's going to tell others and yourself how well you manage your short-term liabilities. How do you manage your bills from day to day, month to month? The very ones that are going to be due quickly. So current and short term, don't worry about these terms really. They mean the same thing. If I use current in one conversation and then say short term in another conversation, they basically mean the same. Current is going to be something within 30 days. Short term is going to be something that's very quickly. So it's going to be the same. Don't worry about the terminology here. They're very intuitive and nothing confusing. The examples of some short-term assets or current assets going to include your cash, your investments. Investments could be a CD, and an investment could include a treasury note, accounts receivable, and inventory. We already know what accounts receivable is, but inventory is going to be the items that you use to generate revenue, and they are going to be things that you sell. And they have a physical substance. So these are not going to be intangibles. They're going to be inventory that you physically have in your organization that you sell to your customers for a profit. Your current liabilities obviously is going to include your accounts payable, and that's going to be your daily bills. And accounts payable could include utility payments, your rent payments, all of the things that you know are going to be due in a month. But it also includes accrued salaries, which is individual employees who have worked and earned money but yet to be paid. And as you know, employees are generally paid either monthly, semi-monthly, or bi-weekly. So that's going to be definitely going to be a current liability. Accrued taxes, same thing, and short-term bank notes. Now, short-term bank notes could be considered, I would say, if you have a drawdown of funds, if you have a line of credit with your bank and you draw down sufficient to make certain that you can pay your bills and your cash is positive, a short-term bank loan would be a working line of credit. That's just one example. I mean, there are many others. Managing current assets. We don't want our money to be sitting in the bank doing nothing. Either we're going to use the money to pay our bills, or we're going to have those funds protected and earning interest, if possible. So we want to make certain that we keep our cash on hand to make sure our bills are being paid, make sure that things that are coming due very quickly can be done. However, we also want to make certain that we protect them by ensuring that no one can get to them and steal them. And a lockbox is a very good way to maintain security with your cash. And when you're talking about an organization that receives a tremendous amount of payments, like a Verizon company or like any other organization that receives cash very quickly, almost with a lot of customers, it's important to have some means to collect that money, to collect it quickly so that the money would be good, but also to ensure that it is, in fact, protected from theft. So a lockbox is a great opportunity for an organization to manage and control their monies, incoming funds from their customers. Now, a lockbox is great if you have a lot of receivables coming in. It is not so great when you have one or two accounts receivable payments a month. It becomes quite expensive. But an organization will consider those kinds of things when they decide to get a lockbox. Marketable securities, they are very important because organizations may have a excess cash that they want to use, but they don't need to use it right now. Marketable securities are good because they are a temporary investment of extra money, and they allow you to put them into these investments and then earn interest. So your money is not sitting in your bank account doing nothing, but is actually being transferred to an account and earning interest for your organization. The same is true for treasury bills. These are again short-term obligations, and the government uses to raise money, but you can use those to invest and to earn interest. So here are some types of securities and the type of maturity dates that are associated with those securities, and the prevailing interest rate, generally speaking. Now we're talking. We're not nailing anything in stone, but it just gives you some guidelines as to the type of securities, the interest rate, and who sells them, and whether or not these items are safe. Now, again, when you're talking about short-term investments, you really want something safe. I mean, you don't want something that's risky for a short-term investment. And generally, you don't want that. It's just counterintuitive. If you're going to have a risky investment, you're going to pretty much hold it for a longer duration to ensure that you can mitigate those possible loss potential. But they include U.S. Treasury bills, commercial paper, and again, these are from corporations, these commercial papers. CDs, you buy them for the bank, and you can also determine how those CDs are being invested. And again, it depends on your organization or the bank that you're using. But these are, again, very, very liquid assets that you have available that you can use for any excess cash. And the book calls it idle cash, but I don't want to call it idle because money is always needed and it's always used. The question is if we're going to use it to earn more money for us in terms of in terms of interest, or we're going to use it to pay our bills. But money's never just sitting there doing nothing. It's always being invested. The hope is that you'll take advantage of your funds that's not being used to pay bills and invest in it to earn you, even on a short-term basis, some interest. How do we manage current assets? Well, we went through a couple, where you invest in securities, but you can also put it into a CD. A CD is just, it's very, very much a locked-in amount. Now, a CD could be for 30 days or 60 days, and they are considered current. But with CDs, you have to be very important to note that you need to keep that money invested for that period of time, or you'll deal with some kind of penalties. And again, these funds that you provide to an organization like a bank, you will, or a brokerage company, you will, use that money to earn interest for you. They take that money and they will buy other securities and other types of investments, and what they earn on those interest amounts, they pay a portion of it to you. So obviously they'll get a higher earning of interest because they pool all their assets into one big lump sum, where they take a little bit of yours and some other organizations that invest institutionally to these larger pools of money and earning a higher level of interest. But the goal is to allow you to utilize the resources of a bank or a brokerage company to earn extra money. Commercial paper is really a promise from one company to pay. It's really like a loan. But what you'll be doing is you'll be loaning money to a corporation so they can finance their operations, or to make some kind of major purchase. They're a little bit more riskier than a CD, but in the end, if they're short term, they are definitely a good option for an organization. A euro dollar market is going to be a trading, U.S. trading dollars in London. And again, these are just ways that you can manage. What are we doing? What are we talking about managing our money? Well, we want to make certain that we have sufficient money, working capital, to pay our bills. But we also want to make certain that any excess monies that we do have available that will be used, obviously, to pay bills, are not sitting and not earning revenue. What we wanted to ensure that every bit of our assets, cash and otherwise, are constantly earning revenue in one way or another. So if our cash is in our bank account, it's not necessarily earning revenues. We want to invest those monies to make it earn revenues. So with our accounts receivable, one of the things that we have is we are, again, We provide a service to one of our customers, and we bill them for that service. That bill that we submit is a IOU. I will pay you, company, within 30 days for the services that we just received from you. So one of the things that I think about accounts receivable is we want to get our money as quickly as possible. So although we have a 30-day period that we're actually legally, required to get our money back, we want to provide some incentives to our customers and say, okay, yeah, you have 30 days to pay this bill, but if you were to pay it within 10 days, we will give you a 1% discount. And those incentives is not so much we're trying to reduce the amount of money we receive. What's most important with this is we're trying to get our money as quickly as possible to either pay bills or to invest. And by doing that, we can say, okay, we are going to get our money. Instead of having a turnover or a accounts receivable turnover of 30 days, we will have accounts receivable turnover of 15 days. That's very good for working capital. Why? Because the quicker you get your money, the more you can invest it into generating more revenues, whether it be in terms of your services that you provide or also in interest. So we want to manage our receivables accurately. We want to make certain that we get as much money quickly as we can, and offering discounts are a great way to do that. Inventory is important. We don't want our inventory to sit. As we mentioned, inventory is the main method by which many organizations like Walmart and others receive income. They are selling their inventory. They are wholesalers. They purchase from wholesalers and other individuals, but at the end, their inventories can't sit on the shelves. They have to be constantly moving their inventory. It's expensive to hold inventory. So how do we manage our current assets? Because inventory is current asset. We want to make certain that we coordinate the flow of our inventory in and out in a quick fashion. So we want to make sure that we have a certain level of inventory to meet our production, or if we're producing a product, or we want to have a certain level of inventory in order to meet the need of a customer that walks in our doors. That being said, we don't want to have inventory shortages. We don't want to have a situation where a customer is ready to pay what we're willing to sell and we don't have it. So managing your inventory is going to be a balance between ensuring that the inventory is flowing out quickly as possible, but with sufficient reserves at an optimal level that you'll always have the inventory for the customer's need. And it is a very delicate balance. There's no right or wrong in this. It's just monitoring your organization and trying to assess through estimates what the level of inventory that you'll need to meet a customer need. At the same time, ensuring that your inventory doesn't sit on the shelves and cost you more and more money. Managing our current liabilities is very important because what we want to make certain is we have money to pay our bills. We know what our bills are, but we want to also make certain that we make use of discounts that we could have. If we have a bill that we're going to pay to one of our vendors, we want to make certain that that vendor gets paid timely for our credit. But we want to also make certain that we, if we can, take advantage of discounts because we pay less money back to our vendor if we pay timely. So when that happens, when we have all these wonderful discounts that have been provided to us, if we can possibly take those discounts, we want to do so. But more often, organizations can't always do that because cash flow may require them to pay within 30 days. So there's also that delicate balance too, where you think, when is it more advantageous to hold on to the money and pay it within the 30 days, and when is it more important to take advantage of the discount? And a lot of accountants and financial managers have to do those kind of analysis to weigh it. How much money would we have to borrow in order to pay our bills versus how much money would we save in terms of discount if we paid it quickly? And no differences between the earnings of our interest or the discount that we're offered versus the amount of money we pay to the vendors. So what we're trying to say here is using our liabilities and timing them sufficiently well, where we are always considering a discount if necessary, or timing payments so that we can adequately pay our bills on time or within 30 days. Obviously, having a 1% discount if you pay within 30 days is always, within 10 days is always good. But if you have to borrow money to pay within that 10 days, would it be advantageous to borrow and offset the interest that you have to pay to the bank with the 1% discount that you will be offered by paying it early? And if you find that your discount offers a better return, meaning your discount either offsets or completely eliminates that interest that you'll have to pay, then it will be advantageous for you to take out a short-term loan to pay your bills. Or if the interest is going to be too high, it might be best for your cash flow to pay within 30 days. But again, it's all about managing your liabilities in such a way that's advantageous to your organization and that gives you the highest return. So organizations they have options that are available to them for the purpose of managing their current liabilities. They can have secured loans, they can have a line of credit, they can have unsecured loans, and they will also be subject to those prime rates. And again, when we're talking about whether or not we're going to use borrowing as a way to manage our liabilities and the way to manage our cash flow, we have to understand what these particular options are and how they're used and how they're best and how they will be best for your organization. So a lot of credit is just really an organization has a certain amount of funds available to them that they can use at any time. They are not going to pay interest on that money until they actually draw the money down. A secured loan really is for organizations that are risky, or the credit that organization has is not very good, if they're a very young company and they're risky for the bank, and which means that they will have to back their loan with some sort of collateral. Sometimes organizations will use their inventory as their collateral. Sometimes they'll use your personal vehicles or their home as collateral. But nevertheless, organizations that have to secure their loan with a bank, generally they are more risky, and the bank feels that they want to protect their asset. Unsecured loans are really for organizations that have a good reputation, good credit rating, and really not going to be borrowing a tremendous amount of money. Unsecured loans are generally under, I guess, $100,000 if their company has a good credit rating. But when you get to higher levels of loans, almost all organizations, all banks or lending institutions are going to require some securitization of their assets, simply because a high $1 million credit line needs something to back it up to make certain that the bank gets their money back. The prime rate really is going to be a good rate because you have good credit standing, you pay your bills timely, but usually that's not going to be something available to a small company. I mean, big companies are usually going to have that kind of rate. But in the end, if you have a small organization with good credit and have a lot of assets that you can secure, you may very well be able to take advantage of that prime rate. So banks are not the only way you can get short-term funds. You can also sell your AR, accounts receivable. And again, when you're talking about financing and you're talking about managing your cash and using factoring as a means to do that, you'll have to be certain that the amount of money that you do receive from your factor does is a good it's actually going to be like an interest rate that you're going to be paying. And when you're doing that factoring, you have to understand you're not going to get 100% of your accounts receivable. And when you don't get 100% of your accounts receivable, you're going to understand there's a difference that you're going to have to deal with. That's going to be the cost of doing that type of business. Now, factoring your accounts receivable is not always the best way to manage your accounts receivable, but some organizations are so small, or because of they're not able to get funding any other way, and they need cash, will use this as a means to do that. I would suggest talking with an attorney before doing something like this, because it can be very expensive to factor your accounts receivable simply because you want to get your money within 2 days of submitting an invoice to your customer. An organization manages their fixed assets. Again, when we're talking about fixed assets, we're talking about long-term assets. These assets are generally for the sole purpose of directly or indirectly generating revenue for a business. So you have to manage those assets. You have to make certain those assets are protected, that they're generally going to cost a tremendous amount of money, and they may very well be paid for over 5 or 6, maybe 10, depending on the asset or years. So you have to make certain that you have the sufficient funds now and in the future to manage those assets, because they are going to be the assets that you'll be using directly or indirectly to generate more revenue for your organization. So if you're going to have a facility that you're going to be using equipment to manufacture or to build something, you need to make certain those assets are sufficiently, that you have those assets and they are working well, that they can be used to generate income. And the options that you can use to manage your fixed assets, your long-term assets, is going to be through a lease. A lot of organizations use leases. Why? Because it's cheaper. It's very, very expensive to purchase a very large equipment asset and have to pay it over a period of months or years. Sometimes leasing is a better alternative. This class does not deal with this lease versus buy option, but you can use that kind of mentality. Well, is it a better idea to lease it at a prevailing rate, or is it better for our organization to buy it? And that's a very good question. We do not go into the details of how to calculate that, but that's very much an option for organizations and what they have to go through to make a decision whether or not option A, leasing, is better than option B, buying. Capital budgeting. Again, this is going to be more of an analytical type of exercise, and what this does is helps an organization see in the future, guess as to what they're going to need in terms of that type of assets that will give them the best value. It is a very important part of an organization, particularly as the organization continues to grow and its need for cash begins to grow as well. So the organization has to strategically plan how to buy these capital assets, and these are long-term assets, and what way to buy them, and what means that we're going to, have, what ways are we going to be able to utilize these assets, and when do we think is the best time to buy these assets to get the best out of them. So capital budgeting is not going to be an exact science. It certainly isn't. It is not going to be 100%, but what it is going to be an educated guess as to what your needs are and how you intend to meet those needs, or in this case, how you intend to pay for it. So one of the things that in the capital budgeting is what's going to be the risk. You have to know what's going to be the risk if I buy it, if I don't buy it, what's going to be the market conditions that relates to this asset, and how important it is for us to determine if it's a high risk. How do we mitigate that risk? So one thing I want to make very clear: this class will not be um, creating scenarios for capital budgeting. What this chapter is intending to help you see is the role of capital budgeting in managing assets. So you need to know what your risk is. And this particular example is just trying to give you an example of how pharmaceutical companies spend a lot of money developing drugs. They take a huge risk. They take a risk because they don't know if that drug that they're developing is going to pass approval. They do, however, have enough information about the process by which the FDA approves drugs to be able to assess the risk and to see if that drug is going to be acceptable or not. So depending on your organizations, you're going to have to know, is it risky? Is it risky? How risky is it? What's going to happen? What will be the potential risk if if this particular item that I'm going to purchase is going to wear out? And that is really important when you're talking about capital assets, because you don't want to buy something that's going to have a useful life of 10 years. When you assess it and you're talking about the risk, it's going to really have a useful life within the market of 4 to 5 years. That's something important to consider. You're also going to have to think about the nature of your business and how competitive it is, because if that particular asset or that project that you're trying to develop and you're trying to get to work, if it's going to be so risky and take so long to implement, you may very well say this risk level is too high. We need to go back and consider something else. And again, when we're talking about capital budgeting, we're talking about whether or not we're going to attain this particular project. If we're going to do it, how risky is it? What's going to be the role of this product over time? Is it going to be obsolete? If it does become obsolete, how long? And that's going to be how long the payback period is. Again, we're talking about capital budgeting. We want to know whether or not we're going to get our money back and how quickly we're going to get our money back. All of these tools together will help an organization make that hard decision to invest this money into a capital item. And again, this is way beyond the scope of the class, because the analysis that's required requires statistics and a whole lot of other things. But what you need to know through learning this chapter is the role of assessing risk, the role of capital budgeting, and how it affects business and its short-term obligations and risk, but it's also its long-term. Now, Long-term liabilities, again, we're talking you can do it through debt, and that's going to be through bonds, through a line of credit, or some kind of loan you usually can get with a bank. But you can also use another way to acquire money. A bond is, I would say, a bond is a way to say, I'm going to issue a bond and I'm going to tell you, whoever buys my bond or the bondholder, that I'm going to pay you interest because you gave me your money to use. And organizations who are using a bond generally will pay it back in 20 to 30 years. This is important information because as a consumer of that will buy a bond, I would like to know why this organization is issuing the bond, what they intend to use it, and also I want to know if this organization is trustworthy. And that's important. So organizations will say, I need to raise money. I don't want to raise money using stock. I want to just, and the board agrees we're going to just incur a liability and we're going to use a bond indenture to do that. So we issue a bond and we say to the bondholders who want to buy them, we will contract with you and we will pay you in 30 years the face amount of that bond. But every 6 months and every year, we will pay you, obviously, an interest rate that is fixed. Now, organizations like to do this because it is a very, very simple way to raise money. It is expensive, but it is a more straightforward way for an organization to raise money, particularly if they don't want to go through the bank. For example, banks will say, I'm only going to lend you $100,000 and that's it. I don't care what happens. I don't care what you do. I don't care how well your organization does financially. You are going to be capped at $100,000. However, if you issue a bond and you're an organization that's established and you have great credit rating and you have a strong financial statements, you may very well be able to raise millions of dollars through a bond indenture versus being stuck with a bank with the risk of maybe only being able to borrow $100,000. So bond indenture agreements generally are going to be for a significant amount of funding. Bonds are issued by governments, by localities, but also by organizations who want to buy another organization. For example, I work with a company that they needed to buy 6 or 7 television stations. Obviously, that would be over $1 billion. Well, you're not going to get $1 billion from a bank. I don't care where you're going, you're not going to get $1 billion. So what you have to do is you have to find out how can you get that $1 billion. And the organization that I work for using it was able to acquire the money in 2 forms. One was an IPO, which is going public, and that was more or less buy stock, which is equity side. And the other half of it was a long-term financing agreement through a bond. And they did it through an indenture, and it was I would say a debenture because it was not secured. And they were able to raise the money to purchase the television stations. And those bondholders received a tremendous amount of money because they got a very good interest rate. And the organization was able to capitalize, meaning leverage, because they had the sufficient debt side of it, or in the case bonds, and they had the sufficient equity to cover that. So they were able to raise the money through issuing stock by becoming a publicly traded organization. And again, these are all about organizations that know that they're going to be around for a while, that they know that what their goals and plans are, and what they are doing now is, this is what we're trying to do. What's the best way to get it done? And using bonds is one of many ways to ensure long-term financing. And in the case of bonds, significant bonds will be long-term financing for tens of millions of dollars. There are types of bonds that are currently in the market: unsecured and secured and serial bonds, and floating rate bonds and junk bonds. For the purpose of this class, understand what bonds are, understand the differences among them, understand the advantages of them will be important. This class is a great overview of all of that, and I want you to make sure that you understand we're not going to be teaching you bonds per se, but understanding what bonds are and their role, and why what one organization choose one set of bonds to another. Finally, we're going to end the chapter with financing with equity. Again, financing with equity is going to be stock. We're going to be either common stock or preferred stock. Again, organizations have to make a very, very serious decision, because when you sell your stock, you're actually taking pieces of your pie and giving it to somebody else. And organizations truly wait before they decide to do this, because ownership means control, and they want to make sure that they have control of what direction the corporation goes into and what types of things that corporations will be doing. So equity financing is a very, very serious decision, and it does not come with a lot of controversy. But it is ultimately the board of directors to decide whether or not financing long term will be best utilized with equity. But equity is another way they do it, and they sell stock to do that, and I have given you just an example of that. Venture capitalist firms are also another way because they will take a part of your business if they provide you with money. But the problem is they don't want to be in your business forever. They'll probably be a part of your business for 2 years, 5 years, all depending on the agreement that they have. But they will be buying a part of your company, and you do not have to pay the money back, which means that your company has to do well, has to be to follow the procedures and the plan that was outlined in the beginning. And there's some limitations, but again, this is money that you can utilize to grow your organization, and you do not have to pay it back. But it is a major, major contemplation, which you need to make certain that it's the right thing to do. But larger companies are sufficiently capitalized, and they have sufficient resources that if they were to make a decision like that, I think that would be the thing that they wanted to do. But know what a venture capitalist will and will not do, and their role in financing long term. This is just giving you some of the things that are with a stock quote. This is not something that you're going to be tested on. We will do some exercises that will help you understand what these mean. But it's just giving you, for organizations that are publicly traded, what their symbol is, what the dividends that they pay, the yield of their dividend, and the number of stock that they trade, and the price of that stock at any given day. And again, what you want to do is understand what the organization is trying to show you about how well they're earning, how much dividends that they pay, and the cost of their shares the price of their shares. There are so many organizations that are, in fact, publicly traded, so you would have a lot of information that you can look at and to do your research. But I would say the most important thing to understand about public companies is that they have the owners of the organization are independent, that they trade on the open market, and that their price per share does change on a daily basis. And finally, most, if not all, the information that you'll need about any public company is available via the internet. And that's very important, which is not true for a private organization. Investment banking is another way that organizations do transact business. Mostly investment bankers are institutional investors. They have the ability to buy massive amounts of stocks and bonds, etc., where you and I will have to go through them to buy them because of the nature of the cost involved. But investment bankers, they are an important part of the sale of stocks and bonds, and they definitely have relationship with other banks. They work with secondary markets. They exchange stock for stock or other securities in the trading floor. And they are also involved in the primary market, where initial public offerings are generally in that area. Trading is going to be over the internet, or trading is going to be at the stock market in New York. And what they do is they trade stocks, and they have stocks in various categories. And as I conclude this chapter, what I would like for you to understand with this particular area is more just the role of the financial, the trading, the investment banker, what their role is, what they do and what they don't do. Don't be concerned about how they carry out those types of transactions, simply because that is beyond the scope of this class, and you'll see that more in a finance class. The securities market is going to be the mechanism for buying and selling stocks. Securities. These investments are allowing individuals or companies to raise money, to invest, to make their money grow. And you and I would probably would be involved in the securities market mostly through a 401k or 457 plan. As individuals, we're not multimillionaires, so generally we can't be purchasers of stocks or other securities as an institution because of our size. But as a group of individuals in a plan, we are involved in the securities markets. And it's very important that we understand what the securities markets can and cannot do, and the things that they are subject to, simply because our investments, our retirement is a part of those markets, and are bought and sold in those markets. Now, this here is just the stock markets that are currently here, the NICE, the NASDAQ, and what they do, electronic trading and all of that. I would suggest going through this chapter with a very loose comb. Again, this is a very small part of the course, and it is not, you're not going to be market analysts, experts by the end of this course, but you will have a very basic understanding of the markets and what they can and cannot do. So, what we need to make certain that we understand about our chapter is what is the security market, what it does, understand some of the terms that are used. This is one over the counter market. What is an over the counter market and what kind of things that they trade? That's all you need to know. Don't get so involved in all of the details because that's so far advanced and it is definitely outside of the scope of the course. But do understand the markets and understand what can be done and some advantages. And what the market does is we have to monitor their performance. I mean, what's how well are they doing? And what investors will need to know is what measures or indices that they use to compare, and how do you know if an organization is doing well? What market performance measure do you need to look at compared to the company you're talking about to measure whether an organization is doing well? But again, don't get too involved into the detail because finance will get into all that detail if you guys are finance majors. These are going to be 30 stocks that are listed in the Dow Jones, and these are just organizations that are very, very large and been out a while. So if you were ever to do a research on any of these companies, you will find a wealth of information about them online. But the most important thing is there are Dow Jones, there are other organizations that will be able to measure their performance. So I would suggest just getting familiar with Yahoo Finance, using MSN Finance, and looking at a few organizations that are public and getting to look at their prices and how they change over time and just understand the basic fundamentals of it. As you conclude the chapter, I would like for you to just to understand how can companies use equity to finance their operations for long-term growth. And one of the causes of the recent recession, how does the market play in that? But more than that, why does organizations use their current assets and their long-term assets to manage their organizational growth, and why do some organizations use debt like bonds to manage their working capital and to manage their long-term assets? This chapter is probably the most fun because it has a very, very useful and practical application. So my hope to you is that as you read the chapter, you formulate some questions of your own that you can bring to this discussion. And again, as I said before, thank you very much for listening, and I will see you in the next one.